Stephanie, I'll start with you. What a difference a year makes as we come into Christmas Eve.
Thanks for the Fed, thanks for global stimulus, fiscal and monetary policy. I mean, it really does, the combination clearly works. But this year was all about multiple expansion, guys. This was not about earnings, right? You went from 13.9 times on the forward S&P 500 multiple last December. You're now at about 18 times forward. We are getting rich. What we really need to see in 2020 is earnings growth. I think you're going to get it. I don't think you're going to get it that much in the first quarter, but I do think you're going to get it in the second half of the year. And that's what's going to be the driver, and what's going to drive that is really the global growth story.
Tom, you said this year was largely about reversing policy errors over at the Fed, and that next year would be about, in your words, animal spirits. By that, do you mean what Stephanie's getting to, and that is earnings rebound, or are we relying on PE expansion once again?
It's exactly what Stephanie said. You know, I think when I talk about animal spirits, I think it's really confidence of not only businesses, so CapEx spending, I think, has upside next year, but it's the recovery in the PMIs that's actually going to deliver, I think, upside to earnings. I think the street's looking for mid to high single digits. I think next year's earnings could be up more than 10%. And so if Stephanie's right and we don't have any PE expansion, you still have a double-digit year for stocks.
Wow. I would take 10%. I was just thinking maybe 5% or so, but I'd take 10% for sure.
Well, historically, single-digit years after a big year are not that common, right?
And then think about it. There are sectors that are trading at a lot lower multiples than other sectors, right? Technology and the FANG stock, they're kind of rich, right? But guess what? Energy's not. They're not expensive if you're going to see a recovery globally. Industrials still have lagged some of the other more exciting places in the market. So there are pockets of where you can actually invest and feel comfortable about on the valuation front, in my mind. And then if you get earnings growth on top of it, that's icing on the cake.
Well, the new highs are definitely attracting bulls back into the market. According to a new report out of B of A, more than $16 billion flowed into U.S. equities just in the past week. That is a 3-month high. Comes as investor sentiment climbed to its highest reading since 2018. Tom, I'm not sure how you feel about this, given that flows and sentiment were something that the bulls used for their wall of worry all year long.
Yeah. Well, you know, I think people withdrew the most money in 2019 and was almost a record outflow for individual investors. So to see some of it come back in is actually good. You know, Merrill Lynch has another great survey where they look at future expectations by institutional investors, and that actually flipped positive. But it's the type of flip that you saw only in 02, 09, and 98. So that sort of flip from really negative to positive tends to have a lot of follow through in it. So I think it's going to really help 2020.